Welcome to accounting school.
Today, we're diving into one of the most important foundations of accounting: types of accounts and the golden rules.
In accounting, all transactions fall into three major types of accounts.
1. Nominal account. 2. Real account. 3. Personal account. Understanding these three types of accounts is the foundation of every accounting system. Let's learn them step by step and make accounting simple.
A nominal account records all expenses, incomes, losses, and gains of a business. These accounts help measure the performance of a company during a specific period. Examples include expenses, salary; losses, bad debts; incomes, commission received; gains, profit on sale of assets.
Nominal accounts start with a zero balance every accounting period, and at the end of the period, they are transferred to the profit and loss account. Nominal accounts record expenses, incomes, gains, and losses, all of which belong only to one accounting period. They do not represent assets or liabilities that continue into the next year. At the end of the year, all nominal account balances are transferred to the profit and loss account, and from there to retained earnings or capital. This process is called closing the accounts. Once the balances are transferred, the nominal accounts become zero, so the next year can start fresh and measure income and expenses only for the new period.
Real account. A real account records all assets and properties of a business what they own.
These can be either tangible assets, like buildings, furniture, or cash,
or intangible assets, like goodwill, trademarks, and patents.
Personal account. A personal account relates to individuals, firms, companies, and any party with whom the business has financial dealings.
There are three types of personal accounts.
Natural persons, like Rahim, Kareem, or any individual.
Artificial persons, like companies, banks, or organizations.
Representative personal accounts. Accounts that represent a group of people, such as outstanding salary or prepaid rent.
The golden rule for real accounts is
debit what comes in, credit what goes out.
This means
when an asset comes into the business, we debit the real account. When an asset goes out of the business, we credit the real account.
Golden rule for personal accounts.
Debit the receiver. When a person or entity receives something from the business, their account is debited. Credit the giver. When a person or entity gives something to the business, their account is credited.
The golden rule for nominal accounts is
debit all expenses and losses. Credit all incomes and gains. Now, quick summary.
Personal accounts, debit the receiver, credit the giver.
Real accounts, debit what comes in, credit what goes out.
Nominal accounts, debit all expenses and losses, credit all incomes and gains.
These rules are the foundation of accounting, helping us record every transaction correctly.